Elaine Kub is our market analyst this week. According to this week's Crop Progress Report, fast development in both crops continue as corn is now 63% silking and soybeans are now 65% blooming and 26% podding. According to the USDA, soybean prices dropped to a 9-year low due to good crop conditions and a hazier export outlook. Corn has also been projected lower by the agency based on observed prices to date and the current status of soybeans. For hard red winter wheat, the production has increased 10.3 million bushels from last month's forecast. We talked with Elaine Tuesday morning to discuss the markets, but began by asking for her analysis of the recent Crop Progress Report.
Yeah, absolutely. It's a very fast progress in the silking, which means pollination is going to happen fast, which potentially means that the grain could dry down faster and we could have a faster harvest. That would have implications for sort of the August-September basis markets, but it's probably too early to say that for sure. In those condition ratings, that we can say for sure, that it's happening faster. We've seen growing degree units accumulate much faster this summer. After a very cold spring, we have 200 to 400 more growing degree units already accumulated in the Corn Belt. So absolutely, it's happening fast, and it's kind of at exactly the wrong time for the crop that's in Missouri and Kansas, where they still have some of that D3 extreme drought. That's where we're seeing the condition ratings drop down. For most of the Corn Belt, the heart of the Corn Belt, most of this crop is still beautiful and still likely to have very high yields, but there's just those pockets in Missouri, southern Iowa, where those crop ratings are starting to diminish.
What do you expect for the prices?
Well, we have really dropped quite a lot in corn, and a lot of that will be due to just seasonally when you have a beautiful crop growing, prices do tend to fall, but mostly corn has been drugged down by soybeans. That price ratio, the soybeans have fallen much more relative to corn, and the soybean to corn price ratio in the new crop markets is only like 2.3 to 1 when it's usually 2.5 to 1. So corn is falling alongside soybeans and alongside soybean meal, but it's established a low at about 350 on that December chart, and maybe that's as low as it's going to get. We are seeing, commercial traders, the commercial processors and the feeders that are going to need this grain long term, they are starting to step into the futures markets and act as buyers.
Well, and also the USDA just reported in the WASDE report that there's going to be higher stocks, acreage, and exports. And so that means quite a bit.
Yeah, and it's a good thing they made those adjustments here early in the summer, because one thing they didn't adjust, Bridget, was the overall yield projection. They left that there at 174 bushels per acre. So that's a huge threat the next time we see a WASDE report next month and the month after that. There's this threat looming over the market that yield number will go up, and the stocks to use ratio and the ending stocks numbers will all probably only become more bearish as the summer wears on.
So soybeans, they're sort of still the hot topic right now. And right now with imports, with the 25% tariff with China and the U.S., right now it's not as a big impact because according to the USDA, exports are usually not even that high during this time of year.
Right, this is not the time of year when we would be seeing lots of movement out of the ports, but price-wise, it has been very interesting to see that the futures prices have fallen almost exactly 25% off of their, beginning of March highs. The cash price discount between U.S. soybeans and Brazilian soybeans is about $1.90, which again is exactly 25% of the cash price of U.S. soybeans. And I don't necessarily think it's a coincidence that we are seeing those prices fall 25%, and then this is the moment when, like I mentioned, the commercial traders are getting in there and saying, this is our opportunity to lock in some prices. You can go out as far as summer 2020, and on the futures board, you can lock in futures for soybean futures at less than $9. So this is kind of a golden opportunity for long-term buying opportunities, which is not to say that it can't fall farther. So it fell that 25% based maybe just on the tariffs, but like I mentioned, that's not to say that it couldn't fall farther based on, the production prospects, just the bearish weather or the bearish conditions if we see them continue through the summer.
Right, because the USDA also reported that that soybeans hit a 9-year low on their prices.
Yeah, so they hit that low. They had sort of a reversal day. They tried that, earlier this month on July 6th. We thought we were seeing sort of a reversal, and it just fell back down, and we were just stuck in this long-term bearish trend. So like I mentioned, I am not necessarily willing to say that the trend is over yet, that it has been reversed, but it is heartening to see that activity getting in there. We're seeing total open interest in the soybean market is rising, which means it's not just short covering. There is actually folks coming in there and buying these futures.
In addition, with these tariffs, right now, instead of the U.S., China is getting more of their soybeans from Brazil. Tell me a little bit more about that.
Yeah, that's the danger, that we are going to turn away some of, or discourage our best customer. Our number one customer has always been China in the past decade. We're going to discourage the best customer to come directly to us and maybe have to go through different channels, less efficient channels, channels that will take more transportation costs or more transaction costs. And in the meantime, they're building up the business that could be coming out of Brazil, or the grain business coming out of Ukraine. China could start looking at these other competitors of ours. So it's not helpful to producers here in the United States when there is inefficiency in those markets, or when there are extra costs in the markets. So the USDA only reduced our total soybean export projection by 250 million bushels in that last WASDE report. But whether that's, the number that ends up being final or not, it kind of doesn't matter, because even the soybeans that do get sold will have to be sold at a lower price to the producers here in the United States. Will have to accept a lower price so that end users can pay the same price. It's just a lot of inefficiency for everybody.
On the other hand, though, wheat has been doing pretty good, especially in Nebraska.
Yeah, yield-wise, farmers are really having a nice time in Nebraska. That hard red winter wheat market is doing well. All of the anecdotes coming out of there as well, the protein levels coming out of Kansas and probably Nebraska were also favorable. So you can say good things about wheat production. And in fact, we also had a nice pop in wheat prices a couple of weeks ago. That was more due to the European wheat harvest, where they're having struggles with wet weather during harvest and perhaps quality losses into a big market that was an export competitor of ours. So we're not seeing that Paris milling wheat chart able to make it past resistance yet. If it were able to do that, then I would expect to see U.S. wheat prices respond in the same way and really start rallying alongside that European wheat market. At this point, it's just sort of bouncing along here, but good opportunities for farmers, perhaps to sell the extra bushels that they have after this good harvest.